Hello friends, welcome to my YouTube channel, BENCODE TV. This is the fourth video tutorial of our forex trading course. Okay, we want to start from where we stop. In our last video tutorial, we talked a lot of things: market structure, currency pairs, major pairs, cross pairs, and all that. Okay, so in this video tutorial, we are looking at the terminology. What are the terminology in forex trading? Section 3, forex terminology. These are very important that you know them, because in the world of forex, these are the things you will be hearing. When you hear pips, lots, how to calculate pip, leverage, short selling, long selling, and all that, how do you understand it? So I'll try my best to explain it as very simple as, so I can easily grab it. I may not be talking about too much grammar, but just give you tips on how you can understand it, so that wherever you hear it, you will not find it difficult to understand. Okay, we want to move to the price terminology. We have the ask price, and we have the bid price, and we have the spread. The ask price is simply the buying price, whereby the bid price is simply the selling price. Okay, the buying price is how much can you buy and how much can you sell, which is the bid price. Okay, let me move to these two. I am going to open a broker website. That is a broker I choose for you. I recommend for you, which is IC Market. And actually, these are the brokers that I'm using. Okay, let me just use some of the information they have here, and that's why it's very good you understand the terminology, because that's the terminology you will be saying. You can see these pips we are talking about. You can see the bid. You can see the ask. Okay, here now it says Euro USD. Assuming you have USD and you want to buy Euro, they are telling you that 1 euro will cost you 1.1692. okay, this is the bid, like we said, the selling price. You understand? Okay, back to that place. So you are going to buy this price. If you want to sell, they will buy this price from you. Okay, you can see that they are kind of selling and buying at the same rate, which is zero spread, because we say here that spread is the difference between the ask and the bid. And this is the reason why I chose this IC market, because I can buy and sell immediately without losing any money. Okay, so okay, for example, see this one, you can buy at this rate, okay, and you can sell at this rate. You see the spread difference here, 0.7. okay, the same thing here. You see that this varies. You can buy at 584, okay, and you can sell at 591. okay, ask is the buying price. I'm so sorry, ask is the buying price, bid is the selling price, because I was wondering how can they sell buy more than what they bought, something like that. Okay, here now you see this is the ask price, how much they can sell to you. Okay, now when they want to buy from you, they can buy at this rate. Okay, if you want to, it's like how do I say it? It's like when you go to the bank, you want to convert your money to a dollar. You see that they will convert it at a normal rate, but when you will now need them to you want to convert your dollar to naira, for instance, in Nigeria, they will do it in a normal rate. But when you want to convert your naira to dollar now, they will want to increase, because brokers, that's the way they make money. Okay, so in this their Euro USD, which is one of the major pairs, they have zero spread here, because there is no difference between how much they can sell to you and how much they can buy from you. Okay, but here they can sell to you at this price, and buy from you at this price. That is the currency of British pounds and US dollar. Assuming you have US dollar, okay, you want to buy British pounds, they can sell this to you, okay, but if you want to sell to them, they can buy at this rate. So this is the ask price, that is the price they can sell to you. In other sense, the price you can buy from them. Let this not confuse you. The ask price, the price you can buy from them, or the price the broker can sell to you. So we normally say that the ask price is the price you can buy from them, okay, because we talk about you. Whereby the bid price now is the price you can sell to them. So these are the currency pairs. Okay, now going back to our trading platform, you will see here, you see sell. You understand how much you can sell now, buy, how much you can buy. You see that you are buying at 461, whereby you are selling at 458. Okay, so that's when you hear that ask is the buying, we are talking about you buying. Bid is the selling, we are talking about you selling, not the broker. Okay, here now you buy at this, you sell as this. So what is the buy now? Can you remember? And what is the sell? Okay, I want you to look at this again. Okay, the buy is the ask price, the sell is the what? Bid price. I'm happy that these guys are not using ask and bid, but in so many platforms you'll be seeing something that, okay, look at it here. Okay, this is the one we are into now. You see the Euro USD, this is the bid price and this is the ask price. Okay, the ask is how much you are buying, the bid is how much you are selling. So I will be using this term ask price, bid price, ask price, bid price, so that you will not be confused about it. And the spread is the difference between this and the, okay, this one now is 58, this is 61. The spread here is what? Is 3, because the difference between 61 and 58 is 3. So when we talk about the spread, that is the difference between the ask and the bid, kind of the profit that those guys made. So you will say, now how can I buy high and sell low? That is why when you buy, you have to allow it to appreciate. You understand? When the stuff appreciates, maybe if the stock appreciates, for instance now, more, their selling price, the price you will sell will equally appreciate, so that when you sell, you will not sell more than what you bought. Assuming you bought at 1.2161, if this thing appreciates, they may be selling now at 1.2178, something like that. Assuming it appreciated, their buying price will appreciate and the selling price will appreciate. By then you now already have the currency. Now you now sell when the selling price has now rise more than what you bought. That's how it works. But there are some currency, they have what we call zero spread, like that Euro USD, but here I'm seeing something different. But according to this broker, they say that Euro USD is zero spread. So which means if you buy and decided to sell without trading, you are not losing any money. Okay, so this is all about the ask and the bid price. There are a lot of other terminology you want to look into. This one is the Pip. We call Pip the change in the currency in 4 decimal places, which is 1, 2, 3, 4. Okay, we say that Pip is equals to 4 decimal places and Pipet is 5th decimal places, but most of the times we use Pip. Okay, why do you need to know this? Let me move to our trading platform. You see here, I normally calculate with 5 decimal places, which is the Pipet. If this thing now move, I'm talking about this 5 now move to 6, we can say that this currency pair has increased by 1 pip. You see, when the 4 decimal places increase, a pip have increased. When it decreases, a pip have decreased. Whereby this is the pipet, you understand, the 8 now. If this 8 moves to 9, it has increased to 1 pipet. it goes down to 7, we see that it have decreased to 1 pipette. So in the market itself, the main platform, they normally calculate, you see it now, 1 2 3 4 5. Okay, 1 2 3 4. This is the pip, this is the pipette, this is the pip, this is the pipette. You know that there are small changes in currency, and sometimes when you do the approximation, you may not even notice that the currency have gained some value. But those who are into forex now, those who understand better, you understand, because we make money through these little changes in currency pairs. 1 pipette, we are going to calculate to know what 1 pipette means to forex trader and what 1 pip equally mean. So, but understand this time, when you hear pips, these are the things they are talking about. Let us move to this broker platform again. You see here, they talk about raw spread from 0.0 pip. You understand? So when you see this pip, I want you to understand what they are really talking about. Okay, you see, pip spread. Okay, these are the terminologies we'll be hearing. This is a pip, this is a pipette, this is a pip, this is a pipette. Okay, I think I have tried to explain it in a very easy, understandable way. What are other terminology we really want to understand now? We want to understand how to calculate. Okay, we want to look into lot. Okay, this is the pip we talk about. Let's move to lot. Okay, lot. Now we see that lot is the standard unit of a trading currencies. We say that 1 lot is equals to 100,000 currency. Mini lot is equals to 10,000. Micro or nano lot is equals to 1,000. Let me go back to the platform so that I will explain better. Okay, back to this our platform. These are the lots we are talking about. When you reduce it to 0.1, we are talking about mini lot. When you reduce it to 0.01, that is micro lot or nano lot. Okay, what we are talking about now is, for example, now this is Euro USD. You have USD, you want to buy Euro. They tell you that you have to pay this. That is the ask price. You have to pay this to buy this, to buy 1 of Euro, as we explained earlier. You have to pay 1.21461 to buy 1 Euro. But here you will not buy only 1 in forex trading. When you select, because they will ask you the number of currency, if you select 1 lot, it means that you are buying 100,000 of euros. So they are going to calculate this times 100,000. So forex market, they are using a lot of money to trade it, but actually you are not going to be the one to pay for that 100,000 currencies. There is something we call leverage, which we explain in the same video series. Okay, so but for now, know what lot is all about. Lot is 100,000 units of that currency. Okay, this is times 100,000 units. That's what you will buy if you select 1 lot. Okay, they are going to calculate this by 100,000 units. But if you select 0.10, you understand, which is the mini lot, that is the 10,000 units. If you want to buy this, they calculate it by 10,000, assuming you select 0.01, which is the mini lot. But if you select 0.01, remember we have 1.0, we have 0.1, we have 0.01. 1.0 here is the 1 lot, standard lot, 100,000 units. 0.1 is the mini lot, 10,000 units. And 0.01 is the micro or nano lot, which is 1,000 units. That's what we have here. So when you select 1 lot, you are buying up to 1,000 units of that currency. Mini lot, you are buying up to 10,000 units. Micro lot, you are buying up to 1,000 units. You notice that this is a lot of money, but actually your broker will give you what we call leverage. They will help you pay some of the money. It is a kind of loaning the money for you to trade. You understand? So when we talk about leverage, I will explain more on this, but understand what lot is all about. And the reason why you need to understand it is because this lot, mini lot, micro lot will help you to understand the profit you will make if you have a pip rise or a pip decrease. Okay, we are now moving to how you calculate your pip. Okay, pip value calculation. We have talked about what one pip is all about, 4 decimal places. Okay, now how do you calculate it? Assuming you have one lot, you are trading with one lot, and there is 1 pip, automatically you are making $10. If there is another pip, 2 pip, $20, just like that. But if you are trading with mini lot, which is 10,000 units, and there is 1 pip, you are making $1. If you are trading with nano lot, 1,000 units, and there is 1 pip, you are making $0.1, which is 10 cents. Let me tell you how we got to calculate this. I just want you to memorize this, but we are going to do the calculation for you to really understand how we get this. But know that when you select one lot, any pip rise give you $10. When you select mini lot, a pip rise give you $1. When you select micro or nano lot, a pip rise give you 10 cents. How do we calculate this? Okay, let me open a calculator. Okay, this is my calculator. Okay, how do we get this now? We have we say that 1 pip is 4 decimal place, which is 0.0001. Assuming that we have now 1 pip. Now, how do we know the value of this 1 pip if you are using a lot? We say that a lot is 100,000, right? So we are going to calculate this 1 pip times 100,000. 1 pip times 1 lot will give us 1, 1, 2, 3, 4, 5. Okay, this is 1 lot, which is 100,000, as you can see, equals to what is giving us 10. So if you select 1 lot and you are able to trade with 1 lot, 1 pip rise you are getting $10, and 1 pip decrease you are losing $10. What about mini lots? The same process. That's the way we get it. Okay, let's still calculate about it. 0.0001, which is 1 pip, times mini lot, which is 10,000. 10, 1, 2, 3, 10,000 is giving us $1. For micro or nano lot, which is 1,000, will give us $0.1, which is 10 cents. So understand this: 1 pip rise, if you are trading with lot, 1 standard lot, we are getting $10, just like that. Okay, we have talked about pip. We have talked about lot. So what are leverage? What actually are leverage? Okay, this is leverage. You know that, as like I said before, currency moves with small amount. So if you really want to make money now, you really want to buy that unit in a very large quantity, so that if there is any single rise, when you will sell all that units you bought, you will make small cash. Assuming you just buy 2 units and there is a single rise, like 1 pip rise, you are not making any money. You are not even making up to 1 cent. So that's the reason why you need to buy a lot of it, so that once there is any slight changes, you make money. So because they know that you have to buy a lot of it, that's the reason why brokers are giving you leverages. We are going to talk about brokers, because I know by this time you must have been hearing me saying broker, and you might be asking what actually is broker. We will soon talk about it. Okay, so don't worry about that. Let's focus on this leverage. Okay, whenever you see a leverage that they say 1.100, they are saying that whatever amount you see there, you are paying only 1%, whereby your broker will pay 99%. Your broker will loan you 99%. Let me not use the word pay, but the reason why I says pay is for you to really understand. They are going to loan 99% of it for you. Okay, let me just explain before I move on to all these other leverage. Back to this place. This is what you want to buy. Assuming you want to buy one lot of this now. You see the ask now at the ask price here. Okay, you are pairing your USD with euro and you want to buy. This is 1.21461. Okay, let me open it here. Let me say you want to buy, and they say that 1 euro will cost you $1.21461. This is what you will use to buy 1 euro, and you have selected one lot, which means you want to buy up to 100,000 units of that euro. Okay, which is this times 100,000, 100, 1, 2, 3. Okay, look at how much we are going to pay. You understand? Which is 1,204,000. Okay, which is $121,461. But actually, you may not have this amount in your wallet with your broker. So now the broker says that they are going to give you a leverage. Okay, maybe you are using this 1:100 leverage, which means you are paying 1%. So what they are saying here is that pay 1% of this, whereby we loan you 99%. Okay, we loan you 99%. Okay, now how do you know how much they are going to charge from your wallet for you to trade with this one lot? Assuming you are using 1:100%, you have to calculate it with this thing now times 1%. Look at how much you will pay. $1,214. $1,214.61. These are how much you are going to pay, and they will complete the rest money. Out of the 12,000 stuff, you are paying 1,000 stuff because you selected because they are giving you this leverage 1:100. So you are paying 1%. So when they give you a leverage of 1:200, actually you are paying 0.5%, not even up to 1%. Some equally give you 1:300, whereby you pay 0.25%. Some give you this 1:500, whereby you pay 0.125%, which is half of 0.25%. Let me say 1/8%. You understand, something like that, 1/8%. Okay, so when you visit a broker, they will be showing you their leverages. Like these guys, IC Market, are giving you leverage of 1:500. They are just saying that each $500 you are paying $1, whereby they are paying for $499, or which is 1/8%, anyhow you call it. Okay, maybe you can use that method to calculate. Each $100 you are paying $1, assuming they are giving you this leverage, which is 1%. For this leverage, each $200 you are paying $1. Here, each $300 you are paying $1, which is 0.25%. So that leverage now, they are not just loaning the money to you because they love you. I just want you to understand this right. They are just giving it to you because they have some competitors, and they know they are really making money when you trade on their platform, because their ask price and the bid price are not always the same. You understand? Even if you just buy immediately and never trade and want to get back your money, sometimes what they are going to buy from you this time around might be a little bit lower from what they already sell to you to trade. That's why when we talk about that, the price can vary. Some brokers, the way they say their own, their price are somehow a little different. Some use what we call 0.0 spread, which means what they are selling to you is exactly what they are going to buy from you, the same amount. Okay, like IC Market, that's the reason why I recommend these guys. They have stayed a long time in the market. Although when we talk about brokers, we talk more about this, and I will list some of the brokers I can recommend. Okay, back to what we are talking about. We are talking about leverage. Okay, I hope by now I must have finished this leverage. This how it works. Okay, I was talking about why are they even loaning this money to you. One is because of the competitors they have. Look at how this works now. Assuming you want to trade something that worth $1 million, due to their leverage. Okay, let me say you want to trade something that worth $210, and due to the leverage they give you, you are only paying $10, whereby they are loaning you $200. What really happens is that if the market begins to go against you, if the currency begins to go against you, maybe there is a drop, a pip drop, maybe from that $210 that is there, the currency drop to $205, the trade will still be there. But once the currency drop to $200, they are going to end that trading and get their money. They will not allow that trading to go beyond the actual money you have put in that market. I don't know whether you guys are understanding what I'm trying to say. Okay, let me repeat again. When they give you a leverage and the market is going against you, once the market finishes the actual money you put in, your broker will automatically end that trading, because they don't want the market to touch their money. In fact, the programs they are using have already been programmed that way. Okay, assuming I'm trading now, maybe I'm trading something that worth here maybe $100,000. Due to the leverage they give me, I only pay $10, and they paid other money. Once this money, the market is going down, which we are going to learn at the end, that should be the final part in our tutorial table of content. If you look at the lesson number 1, that's the introduction, we list out everything we are going to learn. So don't worry about this. Assuming the market is going down like this, going against you, and it goes down to the point that the money you have put there has finished, your broker will automatically end that trading. They have already set that program. So giving you leverage does not really mean that you will lose, they will lose. No, they are not really losing anything. They are just giving you leverage so that if there are increase, you will make more money. You understand? Just giving you chances of making good money if there are increase in pips. But if the thing decreases, so shall your money equally decreases as well. So that's why for me, I recommend you going for this leverage. In fact, this is the leverage I use. There are some brokers that give you this leverage 1:1000, which means in every $1,000 they are, what do I say now, they are paying 999 while you pay 1. But you can see that if you are going for this leverage, any short decrease in pip, you will lose a lot of money. But if there are any increase, you will gain a lot of money. So the thing is like a two-edged sword. You understand? So sometimes it's better you didn't even go for leverage if you can afford that, so that there is no way the currency pair will reduce to zero. You understand what I'm trying to say? But if you cannot afford that, the lesser the leverage you goes for, the better for you. Okay, although it is true that if you go for lower leverage, you may not really make serious money, and you may put too much money there to make little amount of money. If you go for higher leverage, you may put small money to make big money. But when the thing goes against you, you will lose more money. So it's just a kind of when you risk more, either you lose more or you gain more. Okay, I hope this leverage, I have tried my best to explain it better. So if there are things you don't understand, feel free to comment or go through the video all over again. Remember, this tutorial we are looking into now is like the foundation. So if you didn't grab everything here, right, other things might be very, very difficult. So we have to make sure that you understand this stage, especially this terminology, leverage, and how to calculate your pip moves. Okay, finally now let's move into this term of short selling. Okay, in this forex trading tutorial, many people like to use too much grammar, and when they try to define, it might be difficult for you to grab it, and sometimes you may even lose interested. I once encountered such things until I meet somebody that just tell me what I really want to know and stop giving me too much definitions and all stuff. So I'm not going to talk too much about this. I'm just going to hit at the nail at the head. When you hear short selling, we are talking about you selling out from the market. When we hear long selling, we are talking about you buying in the market. Just understand it that way to avoid complications. Let me move to this platform. If I click on this cell now, assuming I am trading, and I click on this cell now, I am going short. If I click on this cell, I am going short. But if I click on this buy, I am going long. Why do we say so, and how do you remember it? Click on this cell is that I am stopping my trading. I may have up to 4 trading platforms. Okay, yes, you can not only trade, you can trade 4 if you can, but I advise you trade 1 at a time. Like assuming I'm trading something like this, 1, 2, 3, 4. If I stop this by selling, you can see that I have closed this. I am going short because in the trading market I have only trade now. That is why we call it short selling or going short. Maybe I close this, you see, I have only 2, I'm going short. But assuming I buy more, I buy this now, you see, I am going long. I buy this, okay, this is already here, I buy this, I am going long. So this is what we mean by short selling and long selling to avoid complications. Thank you so much for your time. Please subscribe to this YouTube channel. Subscription is free. If you love this video, give me a thumbs up. Thank you so very much. Bye bye.